As of the close of the market on Thursday, July 2, 2026 at 4 p.m. Eastern Time, Nuburu, trading under the ticker symbol BURU on the NYSE American exchange, sits at exactly $0.1252 per share. This represents a substantial intraday drop of 23.53% for the session, compounding what has already been an incredibly volatile and downward trending stretch for the microcap stock. While the headline figures paint a picture of a company scraping its 52-week lows, the real insight lying beneath the surface is a sweeping, hyper-aggressive corporate pivot that completely alters the underlying asset. Retail investors scanning penny stocks on their mobile apps see a dying industrial laser company facing delisting, but institutional tracking reveals that Nuburu is systematically converting itself into an international defense and security software ecosystem. It is an engineering firm desperately trying to become a defense contractor before its remaining cash reserves vanish entirely, using cross-border acquisitions in Europe to try to secure a financial lifeline that its domestic operations simply cannot provide right now. The baseline expectation for Nuburu among most casual retail traders and those searching through various online investing sites has long been that this company is a high-risk gamble on specialized blue laser manufacturing. The common narrative says that industrial adoption of advanced welding tech takes too long, that capital equipment purchase cycles are severely elongated due to current macroeconomic pressures, and that the stock is on an inevitable march toward total dilution or a forced reverse split to satisfy exchange requirements. The reality we are uncovering by analyzing their latest June and July corporate disclosures is far more complex and highly contrarian. While the market continues to penalize the stock price, driving it down to these fractional dollar levels, the leadership team is racing against an October 2026 NYSE American compliance deadline by wrapping revenue-generating European defense assets into their balance sheet. They are deliberately attempting to artificially and structurally blow past the $4 million stockholders' equity requirement by acquiring majority stakes in established entities, completely blindsiding anyone who is only looking at old quarterly reports. To understand the intense tension driving the daily swings and trading volumes on this individual brokerage favorite, we have to look closely at the massive institutional and corporate restructuring happening right now. Over 16 million shares changed hands in the last session alone, which is a massive spike in volume for a company with a market capitalization hovering just above $21 million. This sudden liquidity surge is not just retail panic, it is the friction of massive institutional restructuring. Filings reveal complex capital adjustments, like Highbridge Capital Management holding a significant stake through convertible instruments, and Vanguard maintaining a passive baseline. When you see a microcap stock experience a single-day drop of over 23% on massive volume, it usually points to structured warrant conversions or institutional rebalancing, where debentures are being actively converted into cheap equity, putting massive downward pressure on the public float even as the company tries to build an operational floor. If you look at platforms like Robinhood or Interactive Brokers, the automated alerts for Nuburu are flashing red because the historical chart shows a devastating 92% drop over the trailing 12 months. However, the corporate maneuvers executed over the last few weeks present a stark contrast to that price action. On June 17, 2026, the company presented its comprehensive defense plan, centered on a pending 70% acquisition of an Italian defense firm named Tekne. This is not a vague partnership, it is a structured roadmap projecting over $336 million in gross revenue between 2026 and 2029. The acquisition carries a fixed valuation and relies heavily on a capital increase and a revenue-based earnout. This explains why the market is experiencing an intense tug-of-war. Investors are weighing the immediate risk of severe equity dilution against the future possibility of actual cash flow from European military contracts. The pressure cooker is amplified by the fact that the Tekne deal is currently locked in a strict regulatory review process. Italy's government is conducting a Golden Power Review, which is a rigorous state-level screening designed to protect strategic national security assets from foreign corporate control. Nuburu management has explicitly stated they expect this review to conclude in early August 2026. This creates a massive binary catalyst right at the start of next month. If the Italian government blocks the acquisition, the foundation of Nuburu's defense transformation crumbles and the stock will likely collapse through its absolute support floors. If it clears, the company suddenly consolidates millions of assets, immediately fixing its non-compliant status on the NYSE American exchange. This is exactly the kind of deep operational asymmetry that separates superficial technical analysis from real fundamental tracking. Let's add another layer to this situation by examining their domestic pipeline versus their international joint ventures. On June 22, 2026, the company reported that its core industrial laser factory, operating under its subsidiary Lyocon, advanced a $2.2 million commercial quotation for a specialized blue laser rover vehicle. Their current baseline revenue visibility for the year sits at just over $1 million, which barely scratches the surface of what a capital-intensive tech company needs to survive independently. To find investment help or to structure a self-investing portfolio around names like this requires understanding that they are operating as a venture-stage project hidden inside a microcap public vehicle. They have signed a head of terms with an entity called Sun Cubes to jointly design underwater laser power platforms for submarines and maritime infrastructure. It sounds highly sophisticated, but the immediate commercial revenues are modest, capped at initial staged alliances of up to €1 million. Comment below how many shares of Nuburu you currently hold, or if you are entirely avoiding microcap tech stocks in the current economic climate. When you evaluate the broader ecosystem of online investing, major brokerages like Fidelity Investments or SoFi Invest provide tools to look at historical cash flows, and those metrics are where the historical reality of Nuburu gets incredibly dark. If you look back at their annual reports up to late 2025 and early 2026, the business was burning through operating cash at an unsustainable rate, showing a net loss per share of over $2 and a cumulative annual EBITDA in the negative tens of millions. Their current ratio was consistently compressed, and they managed to stay afloat primarily through financing activities, meaning they were issuing convertible debt, selling warrants, and relying on private placements. This constant reliance on toxic financing is exactly why the stock has experienced such severe multi-year downward resets, cascading from double digits down to pennies. The fundamental business model originally centered on the unique physics of blue laser light. Traditional industrial lasers utilize infrared wavelengths, which are highly reflective when interacting with metals like copper, gold, and aluminum. This reflectivity leads to poor weld quality and massive energy inefficiencies in manufacturing environments like electric vehicle battery production and aerospace assembly. On paper, this is a massive technological advantage, especially when major automotive and tech manufacturing lines are trying to optimize their supply chains. The tragic gap between expectation and reality, however, was that changing industrial manufacturing standards requires massive capital expenditures and years of safety validation. Nuburu simply ran out of time and cash before the global industrial base could broadly adopt their hardware. This capital constraint is the exact reason why the rapid pivot towards military and sovereign infrastructure was initiated. The defense sector operates on fixed state budgets and actively seeks specialized laser systems for directed energy applications, secure underwater communications, and drone defense mechanisms. By shifting their technology towards these specialized applications through subsidiaries like Nuburu Defense Limited, management is attempting to tap into government funding cycles that are completely decoupled from traditional commercial market forces. They are trying to bypass the slow enterprise sales cycle by embedding themselves directly into state-level security frameworks, particularly across the European theater, where defense spending sees massive structural increases. Looking forward into the second half of 2026, the absolute limits of this stock's trajectory will be defined by a series of hard, non-negotiable deadlines. On July 31, 2026, shareholders face a critical vote regarding preferred shares that will determine the path towards full ownership of their Orbit asset. Immediately following that, the conclusion of the Italian Golden Power Review in early August will act as the ultimate gatekeeper for the Tekne transaction. If these components fall into place, the next hurdle is October 29, 2026, which is the official regulatory deadline for Nuburu to regain compliance with the NYSE American listing standards regarding minimum stockholders' equity. Finally, looming in December 2026, a $25 million unsecured